So this is the case analysis for FBK or FB Financial, FBK First Bank. Those names are interchangeable. So just a little bit of background. It was founded in 1906, chartered as Farmer State Bank. 1984, Jim Ayers and Steve White acquired it. 1988, they officially changed the name to First Bank, moved the headquarters to Lexington, Tennessee, and Jim Ayers became the sole shareholder. Throughout the 90s, they focused on expansion in West Tennessee, kind of Jackson, Humboldt, Camden areas. And by the early 2000s, mid 2000s, they focused on expansion in Middle Tennessee. They purchased the Bank of Murfreesboro. They also decided to move more heavily into Nashville, as well as more metropolitan areas such as Knoxville in East Tennessee and Memphis in West Tennessee. In 2015, they officially moved their headquarters to Nashville, Tennessee, and they were listed on the New York Stock Exchange in October of 2016. In 2017, they also announced an acquisition of Clayton Bank and Trust, which is headquartered out of Knoxville. So their strategy is, number one, first and foremost, to be a community bank. Now, what does that mean? Community banking means to exist for the customer. They want to basically provide the local community banking experience while offering the technology of a larger bank. So, according to the mission of First Bank, it's to remain true to our heritage as a customer-driven bank, dedicated to proactively providing first-class financial advice and solutions. They want to empower each market with decision-making authority. And so basically what that means is they want to provide some autonomy to their local managers and basically use that local knowledge to exist for the customer and provide and tailor-make financial products and provide financial services for that community. And so really what the focus is now is to expand in those existing markets. So the Porter's five forces. The intensity of rivalry in the banking industry, it really depends on how you define it. So at the national level, it's low market concentration. There's a large number of firms. It's an established industry. However, when you get to some of these more local community, rural communities, the concentration can be pretty high. I know in the home market of Lexington, Tennessee, where First Bank was originally from, First Bank has some 60-70% of the deposits. But the thing that really drives the intensity of rivalry is kind of what drives the bargaining power of the suppliers and makes them both high, which is low switching cost. It's fairly low. It's fairly low cost to go to change your account from one bank to another. And so, kind of transitioning into the bargaining power of suppliers or depositors, same thing. It's low switching cost. So the bargaining power is relatively high for a depositor. It's really not that costly to swap banks. As well as there's really little product differentiation as far as a savings account goes. I know First Bank, they do offer what's called a First Bank First Rewards card, and so that offers more than a traditional savings account, while at the same time basically operating as a checking account. So there is some product differentiation, but it's easy to imitate. So the bargaining power of buyers, high, or this would be borrowers. So there are multiple competitors. There's pretty standardized products, and the price competition is high. It's easy to go from one bank to another and say, well, they offered me this rate, and negotiate for a lower rate. Threat of new entry is low. The entry costs are high. You have to build branches. You have to add personnel, know-how, knowledge, and really the registration and regulatory requirements are pretty onerous to enter the banking industry. Threat of substitutes are low. There are no risk-free alternatives out there in the market. There are money market accounts and things of that nature, but for the most part, there's nothing that's going to provide 0% risk, FDIC insured deposits. The lending knowledge and access to funds to be able to provide the knowledge and know-how of a sophisticated financial product. A bank is pretty much your only option. So the driving forces. What are the driving forces in the banking industry over the next few years? So innovation, online products and services, as well as individual specific products. So consumers are demanding more online stuff. They don't want to have to go to a branch. Anything that you can do in a branch, they want to be able to do online. As well, individual specific products kind of ties into demographics. So we have changing age groups. What this means is, as each demographic group comes in, so as the baby boomers retire, they're going to have different financial needs. As the millennials age, they're going to need access to mortgage loans. They're going to need access to wealth management advice. And as a larger immigrant population comes in as well, they're going to have different financial needs. So it's going to be key that a bank is able to adapt and provide tailor-made financial services to a given group. Economics. So we're in about 8 years into an economic expansion. The longer that continues, the more likely that we're going to see an economic recession. And even the growth that we have seen has been lower growth relative to what we've seen in the past. But what this will provide is some mergers and acquisition opportunities. So as underperforming banks struggle along, they become potential merger targets or acquisition targets. Another driving force, always regulation. So the trend has been toward more regulation. Right now we have a Republican Congress, Republican president, but the overall trend post-financial crisis has been toward more regulation. What does that mean? Well, it means more compliance costs. We have to add additional HR. We have to add additional quality control, training. And what does that also do? It can also restrict the products that the bank can offer, as well as strategy restrictions. We can't act as fast to respond to ongoing events. So the key success factors really pretty much tied right up in to the driving forces. Technology. So going forward, banks are going to have to offer top-rate financial services through mobile apps and online. They're going to have to make branches basically irrelevant for a younger generation. Along with that, though, will be cybersecurity. As everything moves online, financial information is just like health information is extremely important, and so the privacy concerns there are astronomically high. So you have to invest in cybersecurity. Product innovation, what we talked about with demographics. So changing consumer needs, we're going to have to be provide individual specific services. Financial flexibility goes right along with economic growth. So we're going to have to be able to adapt to economic changes. So like we said before, acquisition or expansion opportunities. If you're a financially healthy company, you're going to be able to go out there and find an underperforming bank, not necessarily an unprofitable bank, but an underperforming bank, and be able to acquire that bank and leverage them to the fullest and show them the right way to do it. And so lastly, right along with the regulation is the legal and compliance training we already talked about. So quality control and compliance. I know First Bank has ramped up, especially in the mortgage lending division, quality control and compliance. That also means employee training and monitoring. Regulators are going to want to see that you're actually attempting to show your employees the correct way to behave ethically and to follow new rules and regulations. So our SWOT analysis. SWOT analysis for First Bank strengths, number one, what do they do well? So the strengths and weaknesses, these are internal factors that the bank either does well or does poorly. They're within the bank's control. So the strengths is the community banking, being able to reach out to the customer, to tailor-make financial needs to the individual market that they serve. Financial performance relative to their benchmark firms. First Bank, especially the industry average, outperforms in net interest margin, performing loans. It's substantially outperforms the overall market. We'll get into that a little bit more in the financial analysis, but they're a strong financial performer. They have a balanced business model. By that, I mean they have a very good deposit to loan ratio, about 88%. So what that means is they lend out 88% of the funds that they actually take on as deposits. So what does that mean? It means they're efficiently lending out the deposits that they have, while at the same time providing enough buffer in possibly a downturn to provide some capital in there. Geographic diversification. So at the beginning we talked about the background. They began as more of a rural bank in West Tennessee. Well, they've also expanded that rural presence to East and Middle Tennessee. So what that does is that provides a stable, traditional rural market, but also they're in the large metropolitan areas that are dynamic, fast growing. There's high loan demand growth, especially in Nashville. If anybody's seen the cranes, there's one everywhere you look. So it provides a stable base while at the same time a dynamic growth opportunity. And then mortgage operations. Mortgage has grown astronomically, exponentially over the last 5 years, but they're also very scalable. So they lend online through the consumer direct, like Zillow. They also have correspondent where they buy from other banks. So what you can do with those is, whereas a retail presence you have to build a branch and you have actual employees, these loan officers don't work for the bank, so they can easily just scale those operations back. So weaknesses. Along with the community banking structure, it's a decentralized structure. So what you have is you have decentralized authority, so that can lead to poor decision making. Technologies lag behind. Branch dependency. They have 45 branches throughout the state and one in North Alabama. So as you move to more online, they're going to be stuck with those overhead costs. Growth and culture. As you acquire new companies, it's going to be hard to bring those people in and teach them the culture, the First Bank way of doing things. And then as well, mortgage dependency. So 46%, roughly 40% of the revenue is due to mortgage. Let's say there is a downturn. It is scalable so that we can pull back on our expenses, but at the same time, you're foregoing revenue. So opportunities and threats. These are things that are in the external environment that the bank can't control but must be aware of. So opportunities, expansion and acquisition. There's always the opportunity in the banking industry to go out and acquire underperforming banks, not unprofitable banks, but underperforming banks that we feel that we can go out, acquire, make better, and add to the team. Technology, we've been talking about it, hitting it over and over again. Technology, there's always the opportunity to invest in top of the line financial services, online, mobile, etc. New products through the capital markets division especially. Economic growth, so as the economy expands, loan growth grows. As well as you might see as the economy expands, the Federal Reserve may raise rates. Well, what happens in that case is First Bank doesn't necessarily have to pass on the higher rates to depositors as fast as they can pass on the higher rates to borrowers, so the net interest margin increases. And regulatory relief. I know we talked about it may be tighter. Well, there's also the opportunity that the Trump administration and Congress could get together and peel back some of the excess regulation that came in after the financial crisis. Threats. An economic recession. This would depress loan demand growth as well as rates would go down, and we may also see some increased regulation. There could be industry consolidation. So as the industry consolidates, we have larger competitors that take advantage of economies of scale and ultimately outperform First Bank. A big bank perception. This is a definite problem as the bank continues to grow and become larger, especially as a public company listed on the New York Stock Exchange. People that value the community banking experience could come to perceive First Bank as no different than national competitors. And then lastly, the change in financial intermediation. Banks could lose out to new peer-to-peer lending services. I know that where buyers and sellers of cash find each other. So people who need funds will find people who have funds directly via these peer-to-peer lending sites. So analysis of financials, 2016. The return on assets was 1.35% in 2016 versus the industry average of 1.02%. So outperforming the industry average there, as well as return on equity. Double performance in return on equity, almost 21% versus an industry average of 9%. So as a gross profit margin, in the banking industry, this is what we call net profit margin. So this is the difference between what banks borrow from depositors or from other creditors and what they can lend in their loans. And this was 4.1% versus an industry average of 3.1%, which is pretty great. And then operating profit margin, which includes non-interest expenses as well as income, that was 28%, and then net profit margin was 18%. Now these are within the range of the industry average. But another thing that banks focus on is their efficiency ratio. So their efficiency ratio shows every dollar spent for dollar of revenue. And so the industry average is about 70%. So First Bank still has some room right in line with that operating and net profit margin to improve on their non-interest expenses. But this efficiency ratio actually went down 3%. So it went from 73% to 70% here. So they are improving, and that is one of the focuses for a bank is their efficiency ratio. So list of strategic concerns. Talked about some of these earlier in the threats. Economic recession, increased regulation, industry consolidation, big bank perception, and changes in financial intermediation. All of these are strategic concerns for First Bank because these will be the things that could affect the bank going forward. So recommendations: expand in existing markets. First and foremost, expansion through acquisition, organic growth. You want to acquire underperforming banks. You want to get a good price for them, but you don't want to do failing banks. Obviously, you want banks that are making a profit and are successful. Organic growth. These metropolitan markets that have new people coming in, young people coming in, we can capture that, but we just want to increase market share in existing markets, where markets that we know how to lend in, that First Bank knows, but to just expand the presence there. You want to advertise, social media, radio advertisements, television advertisements, billboards, but that just focus on First Bank's community banking philosophy, as well as the ability to offer top-tier financial services. Information technology. First Bank needs to either hire or acquire a top-of-the-line IT firm at a good price, at a reasonable price, but to design an online website and mobile services and apps that are indistinguishable from a JP Morgan or a Wells Fargo, that allow you to do everything online or on your phone that they do. And it's easily imitatable as long as you can develop the software, because you know what customers want. We go out and you can look at what a big bank's doing. In addition to that, new apps and services like Venmo that allow you to pay people via your mobile app, as well as Acorn. Acorn allows you to invest money. Shows you how much you spend on each thing each month. So just imitate these things. Try to find ways to be innovative and imitate as they come along. And cybersecurity. Customer financial data is extremely important, and that poses if financial data of First Bank customers were to be leaked, and this is irreparable reputational risk. And finally, new capital market department or a new capital markets division. It would be labeled as FB Securities, a new standalone division. They would be registered as a broker-dealer, so they could buy and sell securities. Currently, this division just manages interest rate risk for the mortgage division, as well as provides interest rate swaps for commercial real estate hedging and commercial loan hedging. But as a broker-dealer, it would add some additional risk profile to the bank, but the sheer volume and markup on securities deals, the daily volume and the markup is just a revenue and profitability opportunity that First Bank needs to take advantage of. It also helps build a national reputation. You are dealing with large institutional investors throughout the country buying and selling securities from these guys. And then lastly, it would provide third-party treasury services to smaller banks. A lot of banks outsource their treasury to larger banks, and this gives you a great opportunity to build not only relationships with other banks, but access to local market data that otherwise you might not have access to. And so lastly, questions.